Welcome, freedom fighters. Oil is jumping, the Middle East is burning, the media is screaming World War III, and lots of Australians are about to make property decisions based on fear instead of facts. So here's the question. Does this war really threaten Australian property prices? Or is this exactly the kind of noisy, nerve-rattling moment that creates rare opportunities for calm buyers while everyone else freezes, freaks out, or follows the herd? So today, I'm cutting through the headlines, the hype and the hysteria to show you what this could mean to your home, your loans, your rents, your future wealth, and the next property moves that you should and absolutely should not end up making. And stick with me, because by the end of this episode, I'm going to show you the single biggest mistake that fearful Australians are most likely to make here, and where the smartest opportunities may quietly emerge instead. So, see you on the inside. Welcome to Get Invested on the Property Hub podcast channel, the leading weekly show for Australians who want to learn how to unlock their full self, health and wealth potential. I'm your host, Bushy Martin, and each week I go deep with the best investors, experts, leaders and founders to find out what it takes to break free from the grind, discover freedom and to live by design. Subscribe now and join me and get invested in the life that you really want. Let's get started. Hi, freedom fighters. Let me ask you something right from the get-go. When the world starts rattling its sabres and the headlines start screaming the World War III's begun, what do? Do you freeze? Do you panic? Do you binge on bad news like it's an all-you-can-eat doom buffet? You start second-guessing your property plans, your mortgage, your retirement living, your investment strategy, or your next move? Do you rush to do something, anything, just to feel in control? Or do you slow down, steady yourself, separate signal from noise, and position yourself to survive, adapt, and maybe even thrive while everyone else is glued to the fear factory? Because that's the real question, isn't it? Not what's the scariest headline, but who do you choose to be in times of radical uncertainty? And where are you on the axis of uncertainty right now? Unprepared and numb? Overprepared and hysterical? Or somewhere in the middle, trying to look calm while internally your brain's doing cartwheels in a tumble dryer? And here's the biggest question of all. If a war half a world away can flow through oil, shipping, inflation, interest rates, confidence, jobs and rents, what does that mean for your home, your investment property, your borrowing power, your retirement plan, or your next property decision right here in Australia? Because today, that's exactly what we're going to unpack. Not with panic, not with politics, not with the economist alphabet soup, but with facts, context, history, scenarios, and practical next steps. So, welcome to Get Invested, the real, human, authentic intelligence podcast where we make sense of money, property, life, and freedom without all of the economist gobbledygook and without getting spooked by every headline that flashes red. Because a few years ago during COVID, I watched something fascinating. Same crisis, same country, same headline, same uncertainty, but four very different human reactions. One group froze like startled rabbits in the headlights. Another group went full hysteria mode, panic buying, doom scrolling, stockpiling enough toilet paper to survive a small apocalypse and possibly open their own paper goods warehouse. Another group shrugged and said, she'll be right, did nothing, and confused denial with resilience. But a fourth group, they were different. They got calm. Not casual, not careless, but calm. They took stock. They cut the crap. They protected their cash flow. They built buffers. They controlled what they could. They ignored what they couldn't. They looked for help, and they looked for opportunities and adapted early. And when the dust settled, guess who came out not just safer, but stronger? Yes, you're right, the fourth group. That's when I first called and started framing what I now call the CALM approach, the CALM approach. Because in times of radical uncertainty, the winners are rarely the loudest, the fastest, or the most dramatic. They're the people He can stay clear-headed while everyone else is emotionally outsourcing their thinking to the nightly news. And that matters now because the new wave of war headlines is going to test people the same way. Not just military or politically, but financially, emotionally, and behaviourally. Especially if you're a property buyer, a homeowner, an investor, or a renter, which is most of us. Now, today, I'm deliberately interrupting our Property Wealth Clock annual calendar rollout sequence for this very special episode. Why? Because right now, the growing conflict in Iran and the broader Middle East is about to unleash a full-blown media fear festival. And let's deal with the loudest headlines straight away. You're going to see endless posts, reels, comments, and shock declarations saying, "That's it, World War III's begun." Now, could this widen further? Yes. Is it serious? Absolutely. Have markets already reacted to the escalating conflict, the shipping disruption, and the energy risk? Yes, they have. But calling this World War III might be emotionally satisfying for the algorithm without actually helping you make a single better decision about your money, your property, and your future. Even though the conflict has clearly widened and the economic consequences are now becoming far more serious. So on this episode, I'm not going to feed the fear machine. I'm going to do something far more useful. I'm going to help you think. And let's be honest, the modern media machine doesn't just report fear. It marinates in it. It multiplies it. It adds dramatic music, then serves it up to us 24/7 like a bottomless fear fondue. Because fear keeps our eyeballs glued, our thumbs scrolling, and advertisers smiling. But while the media makes money out of keeping you anxious, my job here is very different. My job is to help you stay calm, stay smart, and make better property and money decisions based on facts, probabilities, and practical actions. Not panic, not politics, not pub talk from someone who suddenly became a geopolitical expert between the second beer and the burnt sausage. Because this story isn't just about missiles, maps, presidents, ayatollahs, alliances, or who said what on the 6 o'clock news. For Australians, and especially for property buyers, owners, investors, and renters, this story is really about what happens when a war half a world away works its way into your petrol tank, your grocery bill, your airline ticket, your confidence, your mortgage rate, your borrowing capacity, your rent, and eventually the value of your home or investment property. That's the real issue here. And here's the strange bit. The places that often look safest in a crisis aren't always the ones that perform best. And we'll come back to that. Because property doesn't usually get hit directly by war headlines. It gets hits indirectly through oil, through shipping, through inflation, through interest rates, through jobs, wages, confidence, and cash flow. And one of the biggest losers from a spike in fuel prices may not be who most people think. And I'll show you why shortly. And as I'm going to say a few times today, all of this is how trouble travels from the petrol pump to the property portal. Now, as I record this on the 9th of March 2026, oil prices have now surged sharply as the conflict widened, with Reuters reporting Brent crude oil around $111 a barrel, up roughly 20%, and the highest level since July 2022. And what now looks like a far more serious choke on flows through the Strait of Hormuz, with tanker traffic effectively seizing up as shipping firms and insurers pull back sharply. Now, to put that in context, $111 US a barrel is still not the worst we've ever seen in oil history, but it is a very different beast from the $60 odd territory many forecasters have been expecting for this year. In other words, there's no longer just a modest fear premium. This is a serious shock price. Not yet full-blown end of days oil, but absolutely high enough to bite hard through fuel, freight, flights, and inflation expectations. And that matters because of the Strait of Hormuz isn't some obscure stretch of water most people couldn't pick on a map with a torch and a compass. It actually handles about 20 million barrels a day, roughly 1/5 of global oil consumption, as well as about 1/5 of global liquid natural gas trade as well. So when that artery gets squeezed, the world just doesn't shrug and move on. And we're seeing that risk turn real, with Reuters reporting Iraqi oil production has collapsed by about 70%, and exports have slumped sharply as Hormuz disruptions worsen. So energy markets react, shipping reacts, insurance reacts, airlines react, financial markets react, and households eventually feel it in the wallet. Now, before we all start hyperventilating into a brown paper bag, let's bring this home to Australia. We're not entering this from a position of silky smooth calm. Australia's inflation is still above target, the labour market is still relatively tight, and the RBA, or the Reserve Bank, has already been forced to keep policy restrictive. The translation? The Reserve Bank isn't sitting back on a beach chair with a pina colada saying, "Beauty, inflation's dead, let's slash rates." No, it's still watchful, still cautious, and still twitchy. So if this conflict keeps pushing up fuel, freight, insurance, and import costs, that can then feed inflation. But, and this is important, because the real surprise here is that higher oil prices can be inflationary and still leave parts of the economy weaker at the very same time. That contradiction is where the property story lives. And it can also do the opposite in other parts of the economy. Because if families have to spend more filling the car, heating the house, or paying for flights, they often don't spend more overall. They simply spend less elsewhere. Less on dining out, less on holidays, less on retail splurges, and less on renovations. And less on discretionary stuff. So the economy can get hit from both sides at once. Higher costs on one hand, weaker spending and weaker confidence on the other. That's why this isn't just an inflation story. It could also become a sentiment story, a growth story, a confidence story, and eventually a housing story. And that's exactly what we're going to unpack in this special episode. Not with academic waffle, not with media hysteria, not with crystal ball nonsense, but with a proper top-down lens. We'll start by looking at the worst-case scenario, because that's what we plan for. Then the best case, because that's what we hope for and manage toward. And then, of course, the most likely case, because that's usually where real life lives. Not in fantasy, not in catastrophe, but somewhere in the messy middle wearing thongs and a bad posture. Then we'll bring it all the way back to Australia. Which states, regions, and locations are more exposed? Which ones might actually benefit? And yes, some parts of Australia could actually come through this better than others. Not because war's good, but because economic shocks never land evenly. And we'll map that out. Then we'll unpack who are the likely winners, who are the likely losers, what happens to inflation, interest rates, consumer confidence, jobs, wages, rents, and housing values. And most importantly, what should you actually do or not do, depending on your age, your income, your assets, your debt, your buffers, and where you sit on the property journey. Because in times like this, the people who do best are not the ones who scream the loudest or predict the boldest. They're the ones who stay composed, read the map properly, and make good decisions before everyone else either freezes or freaks out. So let's start at the top. What exactly is happening now, and how does the conflict in the Middle East actually make its way into Australian property? Now, as I record this, the conflict involving Iran has escalated materially, and energy markets are not treating this like background noise. Reuters reported Brent crude around $111 US a barrel on the 9th of March, with tanker traffic disrupted and roughly 300 tankers stalled around the Strait of Hormuz. Why does that matter? Because Hormuz isn't just another patch of water on the map. The US Energy Information Administration, or EIA, says that flows through the Strait of Hormuz account for about 1/5 of global oil and petroleum consumption, as well as 1/5 of global LNG trade. So when that artery gets squeezed, this stops being a foreign news story and starts becoming an economic transmission story. And here's my big first translation. Wars don't usually smash Australian property directly. They do it indirectly, through a chain reaction. Conflict becomes energy risk. Energy risk becomes higher oil, gas, shipping, and insurance costs. Those high costs flow into freight, food, travel, construction inputs, and household budgets. Then that feeds into headline inflation, inflation expectations, central bank or reserve bank caution, consumer confidence, and business sentiment. That then affects jobs, wages, borrowing capacity, buyer demand, rents, construction feasibility, and housing prices. That, freedom fighters, is how trouble travels from the petrol pump to the property portal. Now, here's where Australia's situation gets interesting. We're a major exporter of some commodities, yes, but we're also heavily exposed to imported fuel pricing and imported cost pressure. So when global oil and shipping costs rise, Australian households feel it fairly quickly in the bowser through transport, through delivered goods, and eventually through broader living costs. And this matters even more because we're not coming into this event with inflation already beaten. The ABS says that Australia's CPI rose 3.8% over the year to January 2026, while trimmed mean inflation rose 3.4%, which is all well above the RBA's 2 to 3% target range. So in plain English, inflation isn't back in the box yet. It's still running hotter than the Reserve Bank wants, which is why the bank can't just relax, put its feet up, and start chopping rates like a butcher on bonus day. At the same time, the ABS says that wages rose 3.4% through the year to the December quarter, which sounds healthy at first blush, but when inflation's also running at 3.8%, it tells you many households still aren't really getting ahead in real terms. They may be earning more dollars, but those dollars aren't stretching much further. And employment was 4.1% in January, which is still low by historical standards, and tells you that the labour market hasn't cracked open the way it usually does in a serious downturn. In other words, most people who want to work can still find it, which is one reason the Reserve Bank still sees the economy as running a bit tight rather than weak. And the RBA lifted that cash rate to 3.85% in February, which matters because that's nowhere near the emergency low rates that people got used to during and after COVID. It means money is no longer cheap, credit's no longer easy, and borrowing power is already being squeezed before any stock from oil or inflation even lands properly. Now, importantly, the RBA has not come out and promised one or two more rate rises this year, but it has made it clear that inflation is still above its target range, the labour market is still somewhat tight, and policy may need to be tightened further, which means rates go up, if inflationary pressures prove persistent. In fact, the RBA noted in February that market pricing had shifted to imply the equivalent of a little more than 3 further rate rises by the end of the year. That's not a promise from the bank, but it's a warning that markets think the risk of more pain has definitely not disappeared. So no, this is not an economy rolling into the sunset with inflation dead, rates tumbling, and households relaxed like lizards on a rock. This is an economy already carrying high housing costs, high living costs, and a lot of stretched nerves. Now, here's the nuance that the headlines often miss. Higher fuel prices are inflationary, yes, but that does not automatically mean households suddenly spend more money overall. Often it means they simply redirect the same household budget. So more on petrol, more on essentials, more on freight-affected goods, and therefore less on eating out, less on travel, less on retail, less on home upgrades, and less on discretionary spending. So the same shock can be inflationary on one side and growth sapping on the other. That's why the central banks like the RBA hate these types of shocks, because they muddy the picture. If inflation rises because of energy and shipping costs, rate cuts can get delayed. But if confidence falls and discretionary spending weakens, parts of the economy can still soften anyway. That's the economic version of being kicked in both shins by the same mule. And here's the important property translation. If this conflict stays elevated, the first pressure points in Australia are unlikely to be two-acre mansions or harbourside trophy homes. The more immediate stress is likely to show up in places where households are more mortgage stretched, more car dependent, more exposed to long commutes, more reliant on variable incomes, or more vulnerable to higher living costs. So think outer suburban mortgage belts, fringe house and land corridors, commuter-heavy locations, and lower buffer households. That's where a fuel and confidence squeeze tends to bite first. By contrast, scarce inner and middle ring locations with stronger incomes, better transport, and tighter supply often hold up better. Not because they're magic, but because buyers there usually have more resilience, more equity, and more choice. And here's the bit that most people miss. The places that feel safest aren't always the places that hold up best. And here's the other twist. Australia's rental market is still extremely tight. SQM research says that the national residential vacancy rate fell to 1.2% in January 2026, and anything around that level is well below what you'd call a balanced rental market. In plain English, there still aren't enough empty properties to take pressure off renters, which is why rents can stay sticky even when buyers get cautious. So even if buyer confidence softens, rents don't automatically roll over with it. In fact, if fewer people can afford to buy, and if investors stay cautious, that can keep rental pressure higher for longer in already undersupplied areas, which means the pain can shift unevenly. Aspiring buyers get squeezed by rates and living costs. Renters get squeezed by availability and sticky rents. Investors get squeezed by finance costs, but supported by rental scarcity if they own the right kind of property in the right location. And here's the open loop that I promised earlier. Some parts of Australia may actually come through this war wobble better than the national mood suggests. Not because they're immune, but because commodity exposure, income resilience, tight supply, and affordability differences mean that some areas will absorb the shock better than others. And that's where we're headed next. But before we get to the worst case, best case, and the likely case scenarios, we need to do one very important thing first. We need a quick reality check from history, as what I've learned from history is that we have a very nasty habit of not learning anything from history, as you've heard me say here many times before. So in my view, if we don't understand how past conflicts flowed through oil, inflation, confidence, and housing, we'll end up confusing today's scary soundtrack with tomorrow's actual outcome. And before we jump into the scenarios, let's stop making this up from scratch and ask a better question. What usually happens when conflict collides with oil, inflation, and property? Because history doesn't repeat exactly, but it does rhyme. And when it rhymes, it usually rhymes loudly, expensively, and straight into your household budget. Now, before I go further, let me tackle the big scary phrase doing laps online. This is the start of World War III. Could this widen? Yes. Could it become much more dangerous? Yeah, absolutely. But let's keep our heads screwed on here. World War II was a full-scale global war between multiple major powers fought across multiple continents with mass mobilisation, industrial war production, and total war economies. What we have here in contrast right now is a serious and escalating regional conflict with global economic shockwaves, especially through oil, gas shipping, trade, and confidence. That is dangerous enough without us needing to slap on the biggest label in the cupboard every 5 minutes. Because once people convince themselves that every crisis at the end of the world, they start making end-of-the-world decisions. And in property, that can be very dangerous and ruinous. So let's learn from the four conflicts that actually matter most for this conversation. Not because they're identical, they're not, but because they show us how war travels through oil, inflation, interest rates, confidence, and eventually into housing. So let's start with the Arab oil embargo in 1973. This was the big one that burnt the lesson into the global economy. Following the Yom Kippur War, Arab oil producers used oil as a weapon, cutting production, imposing an embargo on the United States and some other countries. The result was severe fuel shortages, a huge jump in oil prices, and a nasty mix of high inflation and weak growth that became known as stagflation. Now, that word sounds like something you can catch in a damn motel room. But all it really means is prices rise while growth stumbles. And that's the worst of both worlds. And for property, that matters because when inflation jumps, interest rates usually follow. And when rates rise, borrowing power falls, repayments rise, and property values can come under pressure, especially over time, because higher rates reduce the value of future income streams and tighten credit conditions. So the 1973 lesson's simple. When an energy shock is big enough and lasts long enough, it doesn't just make petrol dearer. It can infect the whole economy. And once that happens, property doesn't get spared. It usually gets squeezed through the rates channel, the conference channel, and the affordability channel. That's the first rhyme. Then came 1979. The Iranian Revolution sparked the second major oil shock of that decade. Oil supply from Iran fell sharply, the market tightened, and global oil prices surged again. The IMF describes this as the final inflationary impulse of the 1970s, with oil prices roughly doubling again by the end of 1980. And this one really matters for today's episode because it reminds us that you don't need every oil-producing nation to be directly at war for prices to surge. Sometimes the fear of wider disruption, the loss of confidence, the hoarding, the insurance blowout, and the market's tendency to panic early can do a lot of the damage all by themselves. And the property translation? If inflation expectations become unanchored, meaning businesses, workers, and consumers all start assuming higher prices are here to stay, then central banks like the RBA get even more aggressive. That's when borrowing costs stay higher for longer, constructions get hit, household budgets get pinched, and leveraged property owners start feeling the vice tighten. So the 1979 lesson is this. Sometimes the economic damage comes not just from the bomb, but from the belief that more bombs, more shortages, and more inflation are coming next. That belief changes behaviour, and behaviour moves asset markets and property prices in some areas. Now, let's move to the Gulf War. When Iraq invaded Kuwait in 1990, global oil prices spiked again. But this time, the price shock was much shorter-lived. The IMF noted that the 1990-91 spike lasted only about 6 months before prices eased and the war concluded. Now that's important because not every war-driven oil spike turns into a decade-defining economic disaster. Some are sharp, scary, and painful, but temporary. And that distinction matters enormously for property. Because if the shock is brief, markets wobble, confidence dips, buyers hesitate, and sentiment goes soft, but the damage doesn't always become structural. It becomes a pause, a bruise, not a broken leg. So the 1990 lesson is duration matters. A short energy shock can spook markets without permanently rewiring the whole system. And for property investors, that means don't assume every geopolitical spike automatically equals a housing crash. Sometimes it means delayed decisions, slower turnover, more caution, and softer confidence. Not Armageddon at the auction. Now, let's come much closer to home. With Russia's invasion of the Ukraine in 2022, which didn't just trigger a humanitarian disaster, it also drove a major global energy and food price shock, especially in Europe, and added to inflation that was already elevated after COVID-era supply disruptions and reopening demand. The IMF said the war would have a severe impact on the global economy through slower growth, higher inflation, and greater uncertainty, with commodity prices rising sharply. And what happened to housing? In many countries, housing slowed not because tanks directly rolled through the property market, but because central banks responded to inflation with aggressive rate rises. And as the RBA has explained, higher rates reduce borrowing capacity, lower the present value of future housing income, and dampen construction as well. That's a huge lesson for us today, because it means the biggest risk for Australian housing from a Middle East war is probably not some direct war effect. It's the indirect effect. Higher energy costs, higher import costs, higher inflation pressure, delayed rate relief, weaker confidence, and tighter household budgets. That's the actual pipe work. That's how the shock gets from the desert and the desert to your doorstep. I'm getting confused. So what do all four of these cases actually tell us? They tell us four very useful things. First, energy matters most when it spreads, not just to fuel, but to freight, food, construction, travel, sentiment, and inflation expectations. Second, duration matters. A short shock can create panic without permanently damaging property. A long shock can embed inflation, keep rates higher, and do real damage to affordability and confidence. Third, property usually suffers indirectly, not directly, through interest rates, through borrowing power, through jobs and wages, through consumer confidence, through construction costs, not because a missile landed in a display village. And fourth, The biggest mistakes usually happen when people confuse the scariest headline with the most likely outcome. That's the real trap. And that's exactly why we're now going to move into the scenarios. Not the clickbait version, not the Hollywood version, but the practical version. What happens if this becomes the worst case? What happens if it cools quickly into the best case? And what happens in the messy middle, the likely case, where higher oil, weaker sentiment, and patchy property impacts all rub shoulders at the same awkward barbecue? So let's start where sensible adults should start, with the downside. What does the worst case scenario actually look like? Again, not the clickbait version, not the bloke on Facebook wearing underpants as a hat and declaring the end of civilization, but the real version, that practical version, the version that matters for your money, your mortgage, your rent, your job, your borrowing power, and your property decisions. The worst case is not just that the headlines get louder. The worst case is that the conflict widens materially and stays ugly for longer. That means more direct strikes, more countries getting dragged in, more shipping disruption, more fear in markets, and more prolonged squeeze through the Strait of Hormuz, which, remember, handles about 1/5 of global oil consumption, about 1/5 of global natural gas trade. So 20% in both cases, which is huge. And if that artery gets partially blocked, or even just remains too dangerous, too expensive, or too uncertain to use normally, then oil, gas, shipping, and insurance costs stay higher for longer. Now, as I've already mentioned, Reuters has reported oil surging to around $111 US a barrel as the war's widened and Hormuz disruption has intensified, with analysts warning that prices could stay elevated while supply risks remain intense. Now, this is where the fear merchants usually stop. They yell, oil up, inflation up, game over. But the real story is nastier than that, because in a true worst case scenario, you can get hit from both sides at once. On one side, higher petrol, higher freight, higher imported costs, higher airfares, higher insurance, higher business input costs, and more inflation pressure. On the other side, lower confidence, weaker consumer spending, more business caution, slower hiring, less travel, less discretionary spending, and eventually a softer economy. That's the ugly cocktail. Not boom, not bust, but a squeeze. The economic equivalent of being slowly sat on by a very nervous elephant. And this is where the property consequences start to become real. Because if energy-driven inflation pushes up again, while inflation is already above the RBA's 2 to 3% target range, well, the Reserve Bank has very little room to ride in like some financial superhero slashing rates and saving the day. As I mentioned earlier, Australia's CPI was 3.8% January 2026, with trimmed mean inflation being at 3.4%. And the RBA lifted the cash rate to 3.85% in February. That tells you that inflation is still above where the Reserve Bank wants it, and rates are already restrictive rather than easy. So in the worst case, what happens? Rate cuts get delayed. They might even go up. Further tightening stays on the table. Borrowing power gets squeezed again. Mortgage stress lifts. Confidence falls. And households are already running hot on big loans, long commutes, and thin buffers start feeling the screws turn. That doesn't mean that all Australian property suddenly falls in a heap. That's lazy thinking. What it does mean is the pressure lands unevenly. And in the worst case, the first places that wear it hardest are actually likely to be places like outer suburban mortgage belts where families are already stretched, car dependent, and highly exposed to petrol repayment costs. Also, fringe house and land corridors where affordability is already tight, construction costs stay tricky, and buyers are more finance sensitive. It also affects tourism-heavy regional pockets where discretionary travel and spending matter to local incomes, as well as lower-income renter-heavy areas where households have the least spare cash to absorb higher living costs. And if we look around the country, that means parts of outer Sydney, outer Melbourne, some growth corridors in southeast Queensland, car-dependent fringes around Perth, and selected regional towns that rely heavily on tourism where fragile local wages could feel the pressure first. Why? Because worst-case shocks hurt most where people have the least buffer, the highest sensitivity to fuel and rates, and the lowest and weakest flexibility to adapt. That's where trouble moves fastest, from the browser to the budget to the bank account to property conditions. And here's another sting in the tail. In a proper worst case, new housing supply can get hit as well. Why? Because higher input costs, higher uncertainty, more cautious buyers, and shakier feasibility make developers, builders, and lenders much more careful. So at the very time that housing affordability is already rotten, you can end up with even less confidence to build the homes that we actually need. That's one reason that rents don't necessarily ease even when buyers go quiet. As I mentioned earlier, rental vacancy is still extremely tight by normal standards, so rental pressure can stay firm even if sales markets lose momentum. So in the worst case, who are the likely losers? Well, the obvious losers are highly leveraged homeowners with little buffer, investors who bought generic stock on thin yields assuming easy refinancing, renters whose wages just don't keep up with living costs, first home buyers waiting for easier conditions that never quite arrive, and small businesses exposed to freight, fuel, discretionary spending, or weaker confidence. But here's the part that surprises people. Even in the worst case, the likely winners are not everyone in cash, and the losers are not everyone in property. That's way too simplistic. In the worst case, the relative winners are more likely to be cash-rich buyers with patience and strong incomes, owners of scarce, well-located property in tightly held suburbs, households with low debt and flexible spending, and selected resource-linked areas where higher commodity prices help support incomes and employment even while the broader mood sours. Now, that doesn't mean they dance through the tulips. It just means they get bruised less badly than others. And that's a very different thing. So let me boil down the worst case into plain English. If this conflict broadens and the energy shock lasts, Australia could face higher inflation pressure, weaker sentiment, delayed rate relief, more household stress, slower housing turnover, patchier prices, ongoing rent pressure, and a much wider gap between quality scarce assets and generic vulnerable stock. That's the real downside. Not Mad Max, not mushroom clouds over the local Bunnings, but a drawn-out squeeze on confidence, cash flow, and affordability. And here's your key Bushmaster takeaway. In the worst case, the biggest danger is not just what happens in the Middle East. It's what happens between your ears while the media tries to convince you the sky's falling. Because panic turns manageable problems into permanent mistakes. Which is exactly why, before we talk about where the real opportunities sit in the best case scenario, I want to bring in the framework that I mentioned earlier that matters more than ever when the world goes wobbly. That's my calm CALM approach. Because when the noise rises, your edge comes not from predicting everything, but from controlling what you can. Because this is where most people get it wrong. They think that survival in uncertain times comes from predicting the future perfectly. It doesn't. It comes from responding to uncertainty better than the crowd. And that's exactly why I keep coming back to calm, CALM. Not as some fluffy, feel-good poster you stick on the fridge next to a magnet and ignore it, but as a practical framework for how to think, act, and position yourself when the world goes wobbly. So breaking calm down, the C is for control, where you control your thinking, your inputs, your costs, and your circle of influence. So you cut the crap, you cut unnecessary spending, and you stop letting the media rent space inside your head. Then the A in calm is for activate, where you activate your access to cash, buffers, savings, and fallback plans. Because optionality belongs to people with liquidity, not people living on the financial edge hoping for a miracle. We then move to the L in calm that represents leverage, where you leverage expertise, relationships, your buying capacity, and you leverage the opportunities that always emerge when the herd freezes, panics, and bolts for the exits. And finally, the M in calm is for manage, monitor, and morph, which is where you manage your mindset, you monitor the changing landscape, and you morph early instead of waiting until events force your hand. Because history shows that periods like this don't just create fear, they also create mispricing. And for long-term, well-buffered contrarian investors, the the sort who can stay rational while others are rattled, that can be where some of the best property opportunities quietly appear. Not everywhere, not in junk, not by accident, but in quality areas with quality assets, when nervous buyers sit on their hands and stressed sellers blink first. That's the difference between a medium momentum investor and a strategic one. One follows fear, the other follows value. So now that we've looked squarely at the downside, let's swing the pendulum the other way. What does the best case scenario look like? Where might the biggest upside actually sit if this whole thing cools faster than the fear merchants expect? And again, this is not the fairy tale version where everyone hugs it out, oil falls tomorrow, rates collapse, and every auction turns into a street party with sausage rolls and overconfident borrowing. But this is the real case, the practical best case. One where the conflict remains serious, but gets contained. That means the fighting stays limited, the wider region doesn't get dragged in a major way, shipping disruption eases, energy markets settle, and the global fear pulse starts fading before it hardened into lasting economic shock. In plain English, the best case is short, sharp, scary, but not structurally damaging. That matters because markets often overreact first, then think later. And property buyers are no different. When fear surges, people pause. They delay decisions. They sit on their hands. They assume something worse must be coming. And that alone can temporarily soften buyer competition and reduce heat in parts of the market, especially where sentiment drives short-term behaviour. But in the best case, once it becomes clearer that the world is not actually ending, the chips are still moving, the energy flows are stabilising, and the shock is more bruised than broken bone, confidence can come back surprisingly quickly. And when confidence returns, something interesting happens, but not in the order that most people expect. People don't usually run back into crypto nonsense, collectible teaspoons, or a goat farm outside Gundagai. They tend to run back towards what feels familiar, solid, and safe. And in Australia, that usually means residential property, bricks and mortar, land, homes in good areas, scarcity, shelter, the stuff ordinary people understand without needing a Bloomberg terminal and a PhD in financial gobbledygook. So in the best case, what are the likely economic consequences? You'll probably see the initial inflation pulse fade rather than embed. Central banks, including the RBA, would remain cautious, but they'd have less reason to keep leaning harder on the rate brake. Consumer confidence might wobble but then recover. Discretionary spending would likely take a short shock, then normalise. And housing markets would do what they often do after the fear of a wobble. They split. The better quality, scarcer, better located stock would likely recover first. Generic, easily substituted, less desirable stuff might actually bounce less or take longer. Because in every market, fear eventually fades, but quality still matters. And this is where a contrarian viewpoint belongs absolutely front and centre. In the best case, some of the smartest buyers are the ones who act during the fear window, not after the all clear. Because once the herd realises the apocalypse has been postponed again, they pile back in. That's when competition rises, urgency returns, FOMO comes back wearing shiny shoes, and the discounts start quietly disappearing. So if you're a well-positioned buyer with strong buffers, stable income, and a long time frame, the best case can actually produce a very attractive setup. Temporary fear, less competition, more negotiability, and the chance to secure quality asset before the crowd re-enters the room. That's why some of the best property fortunes are built not in boom times when everyone feels clever, but in certain times when disciplined people can still think. Now, where in Australia might the best case resilience show up first? Well, most likely in scarce inner and middle ring suburbs of the major capitals where supply is tight, owner-occupier appeal is strong, and buyers tend to have higher incomes, more equity, and more staying power. So again, think parts of Adelaide's tightly held family suburbs, Perth's better located established areas, Brisbane's scarce inner and middle ring, selected Melbourne and Sydney suburbs where quality stock is always rare, even when sentiment wobbles, and lifestyle markets with genuine scarcity rather than speculative hype. Why those places? Because the best place because the best case favours markets where demand returns quickly once fear fades and where scarcity does the heavy lifting, not oversupplied stock, not fringe estates where one paddock turns into three more, not investor-grade vanilla with all the personality of a microwave manual. The best case also potentially helps well-chosen investors in tight rental markets. If would-be buyers pause briefly, but renters still need homes, and supply remains constrained, then rents can stay supported while acquisition opportunities improve. That's a lovely little combination for a smart investor. Solid tenant demand, less buyer competition, and the chance to buy value while other people are doom scrolling. Now, to be clear, the best case doesn't mean everything flies. It doesn't mean every suburb wins. And it definitely doesn't mean you go out and buy rubbish because war discount sounds exciting. No. The best case rewards the same things that usually win over the long term: quality, scarcity, cash flow resilience, good local economies, strong owner-occupier appeal, and buyers who still have financial oxygen when others don't. So the simple summary of the best case is this: the conflict stays contained, the economic shock eases, confidence gradually returns, and strategic buyers who acted during the wobble get rewarded as normality starts to rebuild. Or said another way, the best opportunities often appear in that awkward little window between everyone's scared and everyone's confident again. And that window is usually much shorter than we think. So that's the upside. But now we come to the most important part, not the catastrophe, not the fairy tale, but the scenario that usually turns up wearing sensible shoes and a slightly worried expression, the likely case. Because in real life, markets usually don't give us the disaster movie or the Disney ending. They give us the messy middle. So what does the likely scenario actually look like? Well, in my view, the likely case is not full-scale economic carnage. It's not a quick, tidy resolution where everyone calms down, all drops, and open homes go back to feeling like a Saturday morning stroll with a flat white in hand. The likely case is messier and a bit harsher than that. It's a drawn-out period of elevated tension, patchy disruption, higher energy costs, more nervous headlines, and a slow drip squeeze on confidence. Not a brick through the front window, more like a leaky tap behind the wall. Not dramatic enough to flood the whole house in one hit, but annoying enough to do damage if you ignore it for long enough. That's the likely case. In other words, the conflict remains serious, the rhetoric stays hot, shipping and insurance stay more expensive, oil and gas stay elevated compared to where they were before this escalated, and households, businesses and central banks all become a bit more cautious. That broad shape fits what markets have already been reacting to. Oil surging as the Iran conflict widens, shipping through Hormuz disrupted, and the RBA's February outlook already has inflation running above target for some time, with the labour market still a little tight. Now here's where the likely case gets interesting, because the pain doesn't usually arrive wearing a giant name badge that says, "Hello, I'm inflation." It sneaks in sideways, at the Bowser, at the checkout, in freight bills, in airfares, in insurance, in school fees, supply costs, delivery charges, and all the little bits of life that slowly start nibbling at household cash flow like 1,000 financial mosquitoes. And that matters because even if total household spending doesn't rise much overall, the composition of spending changes. More goes to fuel, transport, and essentials. Less goes to dining out, retail treats, holidays, home upgrades, and other discretionary spending. So the likely case is inflationary in the cost of living sense, but not necessarily boom-like for the broader economy. It can still leave parts of the economy feeling slower, softer, and more cautious. That's the contradiction that the headlines miss. And that contradiction is exactly where the property story lives. Because in the likely case, the big question is not, will all property rise or fall? That's playground stuff. The real question is, which households, which suburbs, which price points, and which property types wear the squeeze hardest, and which ones quietly keep going. Now, before I answer that, here's the twist. The likely losers are not always the obvious losers, and the likely winners aren't always the wealthy suburbs with the fanciest coffee. We'll get there in a second. In a likely case, 5 things are most likely to happen here at home. First, rate relief gets delayed or at least becomes shakier. Not because the RBA wants to annoy everyone for sport, but because when inflation is still already above the 2 to 3% target band, any renewed pressure through fuel, shipping or imported costs makes it harder to feel comfortable about easing policy quickly. The Reserve Bank hasn't promised more hikes, but it has clearly said inflation is expected to stay above target for a while longer, and market pricing has been allowing a further tightening risk, which they're pricing in more rate rises. Second, consumer sentiment stays fragile. Households don't need a full-blown recession to become cautious. They just need enough uncertainty, enough media noise, and enough extra pressure on everyday costs to start saying, maybe not yet. Maybe we wait. Maybe we hold off on that renovation, that holiday, that upgrade, that next purchase. That waiting game matters for property because it cools urgency. And when urgency cools, property conditions don't always crash, but they often go quieter, slower, and more negotiable. That's one of the reasons why periods like this can create opportunity for strategic buyers. Not because panic is pleasant, but because hesitation creates price discovery. Or, said another way, when everyone else is nervously checking the headlines every 6 minutes, the prepared contrarian is often the one finding value while the herd is still looking for the emergency exit. Third, the housing market splits more sharply by location and buyer type. This is where broad brush national averages become about as useful as a chocolate teapot, because the likely case doesn't land evenly. The more vulnerable areas are still likely to be outer suburban mortgage belt locations, car-dependent corridors of long commutes, fringe estates where affordability is stretched, and areas where buyers are highly sensitive to finance costs and weekly cash flow. So parts of outer Sydney, outer Melbourne, some growth corridors in southeast Queensland, and some fringe pockets around Perth could feel more buyer hesitation if fuel rates and confidence all keep squeezing at the same time. Not because those areas are bad, but because households there are often more exposed to the triple whammy of mortgage stress, petrol costs, and thin buffers. That's a nasty combination, like trying to juggle chainsaws while riding a unicycle on a gravel road. By contrast, the more resilient areas, in the likely case, are probably well-located inner and middle ring suburbs, tightly held family areas with genuine scarcity, established neighbourhoods with strong owner-occupier appeal, and selected markets where incomes are stronger, commuting burdens are lower, and buyers have more equity and more staying power. So, think parts of Adelaide family suburbs with constrained supply, selected established areas of Perth, better located middle ring parts of Brisbane, and scarce high amenity pockets in Melbourne and Sydney where quality stock remains rare even when confidence wobbles. Why? Because when people get nervous, they usually become more selective. And when buyers become more selective, quality and scarcity start doing the heavy lifting. Fourth, rents are likely to stay sticky even if buying slows. Now, this is the one that a lot of commentators miss. People often assume that if buyer confidence fades, housing pressure fades too. Not necessarily. If fewer people can buy, if investors remain cautious, and if new supply doesn't magically appear out of the hat, rental pressure can stay firmer than people expect. Australia's rental market was already tight coming into this and still sits well below more balanced conditions. So the likely case is not buyers struggle, therefore renters rejoice. No. The likely case is more like buyers get cautious, investors get selective, construction stays patchy, and renters keep feeling the squeeze in undersupplied areas. Which means the likely losers include renters whose wages don't stretch far enough, and first home buyers who are trying to save a deposit while costs keep nipping at their heels like a terrier with a grievance. Fifth, this environment can produce very good buying windows for prepared investors. Not reckless investors, not headline chasers, but prepared investors. The kind with buffers, with confirmed buying capacity, with a quality filter, and the emotional discipline not to confuse temporary fear with permanent impairment. Because if the likely case plays out the way I think it might, you get exactly the sort of conditions that often suit contrarian property investors. More uncertainty, less competition, more caution, more negotiating room, and a nervous herd waiting for someone else to tell them it's safe again. And by the time the all clear finally gets stamped across the headlines, the better opportunities are often already gone. That's the quiet truth about these periods. The bargain window usually closes before the average punter stops feeling scared. That's why one of the oldest truths in investing is that value often appears before reassurance does. Not because fear makes everything cheap, but because fear often makes good assets temporarily mispriced while human beings act like human beings. So who are the likely winners in this middle path? Well, the winners are likely to be buyers with cash flow, buffers and patience, owners of quality, scarce property in tightly held locations, investors who can buy well-located assets without stretching themselves like an old pair of bathers, and households with stable incomes and low enough debt to let time do its work. And the likely losers? Highly leveraged households, thin yield investors in generic stock, renters with little buffer, buyers relying on the hope of imminent rate relief, and anyone making big financial decisions with the television on and the spreadsheet off. So if I boil the likely case down into one sentence, it's this: higher costs, weaker confidence, delayed relief, sticky rents, patchier prices, and better opportunities for the calm, the liquid, and the selective. That's the messy middle. Not the end of the world, not no impact at all, just property conditions that become more uneven, more emotional, and more rewarding for people who can keep their head, while others lose theirs, and then blame the Middle East, the media, the banks, the government, Mercury being in retrograde, and possibly their Labrador. Now, if that's the likely backdrop, what does it actually mean for different people in different life stages? What should first home buyers do? What should investors do? What should homeowners, renters, pre-retirees, and older asset holders do differently from here? Because this is the point where information has to turn into action. So let's bring this down from the global chessboard to the kitchen table. What does all of this mean for you, depending on your age, your income, debt, assets, and your stage of life? Because this is where most people go wrong. They listen to a big macro story, nod thoughtfully, say, geez, that's interesting, and then do absolutely nothing differently, which is about as useful as buying a fire extinguisher and then using it as a doorstop. So let's make this practical. Not everybody should respond the same way, because a 28-year-old renting in Brisbane with a growing income and no kids shouldn't react the same way as a 61-year-old pre-retiree investor with multiple properties at crook knee and a low tolerance for drama. Different people, different risks, different moves. And one group in particular may actually have more opportunity here than the headlines would suggest. So let's start with first home buyers. If you're an aspiring buyer, this sort of environment can feel horribly unfair. And to be blunt, it is. Because you can get hit from both directions. Higher living costs make it harder to save. Borrowing conditions stay tighter for longer. And rents may not ease enough to give you breathing room. So what do? Well, first, don't buy based on hope. Don't assume rates will magically tumble, banks will suddenly become generous, and everything will get easier by spring. Hope's not a strategy, it's a mood. And moods don't pay mortgages. Second, buy less, but buy better. Now, that may mean a smaller home, a slightly less sexy postcode, or an older dwelling with better land content and better long-term fundamentals. And on certain times, borrowing to your absolute eyeballs for something shiny but mediocre is a bit like buying white linen pants before a spaghetti festival. Looks exciting, ends badly. Third, stress test your life, not just a loan. Can you still cope if petrol stays high, groceries stay ugly, insurance rises, and your repayments don't fall as quickly as the headlines promised? That's the real test. Because what breaks households is rarely one big thing. It's a series of annoying things arriving together like uninvited relatives at Christmas. And here's the curiosity twist. For some first home buyers, a fear-heavy market can actually help. Why? Because when others hesitate, competition can thin out. And if you're prepared, pre-approved, clear on your numbers and disciplined on quality, you may find you can buy better than you could in a full-blown FOMO frenzy. Not because the world's improving, because human behavior is temporarily getting in your favor. Now, let's turn to existing home buyers, homeowners. If you already own your home, your mission is pretty simple. Protect the castle. Not impress the neighbours, not renovate the pantry like you're auditioning for the block. Just protect the castle and pull up the drawbridge if you need to. That means protect cash flow, protect buffers, protect borrowing flexibility, and protect your peace of mind. If the world goes wobbly, the households that sleep best at night are not always the highest income households. They're the ones with breathing room. So review your offset, your redraw, your repayments, your fixed versus variable mix, your insurance, and your emergency reserves. In uncertain periods, financial oxygen matters more than financial bravado. And here's the thing that people often miss. If you already own a quality home in a quality area, you don't need to react to every headline like a meerkat on espresso. Sometimes a smartest move is not doing something dramatic. It's quietly strengthening your position while others perform emotional gymnastics in the news cycle. So let's now consider the impacts on my favourite breed, property investors, which for me is the fun bit. Because this environment, while uncomfortable, can actually be very fertile ground for the right investor. Not the over-leveraged, spreadsheet optimistic, TikTok taught investor who bought rubbish because the brochure had nice trees on it. I mean the strategic investor, the contrarian investor, the investor who understands that periods of fear and uncertainty often create the best buying windows for quality assets. This is where Warren Buffett's old line about being greedy when others are fearful really earns its keep. When others are fearful, the calm investor with buffers, clarity, and financial capacity can often pick up better value while the herd is either exiting or sitting on its nervous hands. Then later, when confidence returns, money gets printed, rates ease, or government stimulus rides in wearing a cape made of borrowed dollars, those same assets often rise on the next wave as everyone piles back into the perceived safety of residential property. That's the slipstream. That's where fortune quietly gets built. But, and this matters, not every property becomes an opportunity just because the headlines are scary. In times like this, your filter needs to get tighter, not looser. So investors should focus on quality locations, scarcity, owner-occupier appeal, strong land component, solid rental demand, cash flow resilience, and enough savings or equity buffer to hold comfortably if the market stays awkward for longer than expected. So avoid generic stock. Avoid thin yield stuff that only works if rates fell yesterday. Avoid fringe oversupply. And avoid mistaking discounted for desirable. Some things are cheap for a reason, like petrol station sushi. Now let's turn to renters. Renters wear a particularly nasty squeeze in this sort of conflict environment because you don't get the upside of ownership, but you still get hit by the downside of higher living costs, tight housing supply, and sticky rent pressure. So if you're renting, the goal isn't perfection, it's stability. Now that may mean locking in a longer lease if the numbers work, reducing unnecessary moves, sharing more strategically, or choosing practicality over postcode vanity. A slightly less glamorous location with better weekly survivability can sometimes be the smartest move on the board. And if you're a renter wanting to become a buyer, then this is the time to build the habits that future-proof you. Save buffers, clean up spending, reduce debt, improve serviceability, and get crystal clear on what you can actually genuinely hold, not just what a glossy calculator says that you might scrape into. Because in uncertain times, resilience beats aspiration every day of the week. Moving on, let's now consider pre-retirees and retirees. If you're older or moving toward retirement, your priorities shift. This is not the time to play cowboy. It's the time to protect income, liquidity, sleep, and flexibility. You don't need maximum upside. You need durable downside protection. That means asking, how exposed am I to higher costs? How much debt am I still carrying? How dependent am I on market timing? Could I hold comfortably through a rough patch without becoming a forced seller? Because in later life, forced selling is the real enemy, not volatility, not scary headlines, forced selling. That's what turns temporary stress into permanent damage. So older households and older investors should generally lean toward stronger savings and equity buffers, simpler structures, more predictable cash flow, less speculation, and fewer decisions that depend on everything going exactly to plan. Because life really does. It tends to arrive more like a Labrador through a screen door. Now, let's shift to younger accumulators. If you're younger with time on your side, there's actually a hidden gift in uncertain periods, and that's time. Because if your income's growing, your debt's manageable, and you can buy quality assets without breaking yourself, then volatility and fear can become your friend. Not emotionally, but financially. Because your greatest edge isn't experience, it's runway. You've got the time for compounding to do the heavy lifting. So for younger accumulators, the key is get into the right asset, in the right location, at a sustainable level, and hold it long enough for the crowd's emotional swings to matter less than the long arc of scarcity and growth. That doesn't mean rush, but it also doesn't mean sit in permanent analysis paralysis, waiting for a mystical perfect moment that arrives riding on a unicorn. So, who are the likely winners from escalating overseas conflict? If I strip this right back, the likely winners are the calm, the buffered, the liquid, the selective, the well-advised, and those who can still act when others can only react. They're the people who treat uncertainty as something to price, not something to fear blindly. They control their thoughts, their costs, and their choices. They don't confuse a scary narrative with a broken investment thesis. And they buy quality when quality becomes temporarily negotiable. On the flip side, who are the likely losers? Well, the likely losers are the thinly buffered, the over-leveraged, the emotionally reactive, the headline-led, the low-yield chasers, the generic asset buyers, and the people who keep waiting for a certainty before they act. Because certainty is rarely available at the point of best value. By the time certainty arrives, the price usually has too. So the real dividing line in all of this is not rich versus poor, or owner versus renter, or young versus old. It's this: prepared versus unprepared. That's the line that really matters. And that's why the next step is not another macro lecture. It's a practical checklist. What should you do from here? And just as importantly, what should you not do while the media is trying to turn uncertainty into a full-time job inside your head? So let's finish where good strategy always should, with a simple, practical playbook for what to do next and what mistakes to avoid while everyone else is losing the plot. Because information without action is just mental wallpaper. And fear without a plan is like handing your financial future to a drunk bloke with a foghorn. So let's make this very practical, not theoretical, not academic, not another bowl of economic porridge, but a playbook. So let's look at what to do, starting with controlling your inputs before they control you. Because the first thing to do isn't financial, it's mental. Because in times like this, your biggest risk may not be the war itself. It may be the amount of fear you consume about the war. So reduce your intake of the 24/7 fear factory. Stay informed, yes, but don't marinate in catastrophe. There's a big difference between being aware and being emotionally waterboarded by breaking news alerts every 11 minutes. Because once fear gets in your nervous system, it starts pretending to be strategy. And it isn't. It's just anxiety wearing a suit. So step one is curate your inputs. Less doom scrolling, more deliberate thinking. Less reacting, more reflecting. That's the first and most important form of calm, or CALM. Secondly, double check your cash flow. So next, review your household numbers, not next month, but now. Look at your living costs, your fuel sensibility, your debt commitments, your savings buffers, your insurances, your spending leaks, and your fallback capacity. Because when uncertainty rises, cash flow becomes king, queen, and half the royal family. This isn't about becoming a frightened squirrel hoarding acorns under the floorboards. It's about making sure you have enough breathing room to make good decisions instead of desperate ones. And here's the bit that most people avoid. Find out exactly how much financial oxygen you actually have. Not how much you hope you have. Not how much you reckon you've got in your head, but how much you truly have. Because opportunities only belong to people who can stay solvent, stay calm, and stay in the game long enough to act. Thirdly, strengthen your buffers. If your savings and equity buffers are thin, start rebuilding them now. This means having access to enough funds through savings or available equity in your offsets that you can live for a minimum of 6 months if your income stopped today. Now, that might mean parking your ego for a while, cutting unnecessary spending, delaying vanity upgrades, tidying up bad debt, improving liquidity, or simply becoming more intentional with what leaves your account. Because in uncertain seasons, cash in the bank isn't laziness, it's optionality. It gives you time, it gives you choices, and choices are incredibly valuable when everyone else is trapped between fear and forced decisions. So if you need some guidance on all of this, email me at hello@knowhowproperty.com.au and ask for a free copy of our kick-ass automatic saver system that I detailed in my book, The Freedom Formula. Then comes number 4, get very clear on your buy box. If you're planning to buy a property, don't widen your criteria just because headlines create wobble. Tighten them. Know your buy box. Know your maximum price. Know your target yield. Know your ideal locations. Know the difference between quality and false economy. In periods like this, the temptation is to think maybe I should just buy whatever looks cheap. No, that's how people end up in the financial equivalent of a rebound relationship. Lonely, regretful, and wondering how they ignored all the obvious red flags. So define your property buy box before you go hunting. That way, you're responding to value, not just reacting to fear. Then comes number 5, buy quality, not noise. If an opportunity emerges, focus on quality assets in quality areas with scarcity, owner-occupier appeal, good land component, solid rental demand, livability, long-term desirability, and enough resilience that the asset still makes sense even if the market stays awkward longer than expected. This is not the time to get seduced by junk in a shiny wrapper, because low-grade assets often get cheaper in a crisis. High-grade assets sometimes just get negotiable. That's a very different thing. And here's the curiosity twist. Often the best buying window is not when everyone else is panicking loudly. It's just after that, when most people have become cautious, fatigued, and indecisive. That's when quality can still be bought without the full crowd coming back in. Let's now turn to number 6, lean on expertise. This is not a solo sport. In uncertain periods, good advice matters more, not less. So lean on quality expertise. Not hype merchants, not adrenaline junkies, not opinionated uncles with strong views and weak track records, but real expertise. People who understand strategy, finance, cash flow, risk, property selection, and long-term positioning. Because borrowing mistakes, location mistakes, and timing mistakes all get more expensive when the world turns slippery. And as I often say, poor people pay twice. Once for the cheap advice, and again for the mistake. Then comes number 7, keep playing the long game. This is the big one. Remember your time horizon. If your property plan is built properly, this episode should not turn you into a day trader with a blood pressure problem. Property is still a long game, a scarcity game, a cash flow game, a time in the market game, not a respond wildly to every geopolitical tremor game. That doesn't mean ignore reality though. It means put reality in proportion. Because if your assets good, your debt's manageable, your buffers are solid, and your time frame is long, then short-term fear often matters less than people think when they're actually in the middle of it. Okay, let's now flip this and focus on what not to do by turning to the traps. Because avoiding big mistakes often matters more than making heroic moves. So firstly, don't panic sell good assets. If you own quality property and your fundamentals are still sound, don't let a scary headline bully you into making a permanent mistake. Panic selling a good long-term asset because the news cycle has gone feral is a bit like burning down your house because you saw smoke from someone else's barbecue. Not clever, just expensive. And believe me, I've seen a lot of intelligent investors fall for this in the past and still live with the regret that follows. Secondly, don't assume every crisis ends in a crash. That's lazy thinking. Some crises create temporary fear. Some create lasting economic damage. Some create a pause. Some create a buying window. Your job is not to react to the category name, is to assess the actual transmission effects on your life and your market. Thirdly, don't over-leverage into hope. Don't stretch yourself to the point where everything has to go right, because in uncertain times, a strategy that only works if rates fall quickly, costs seize, tenants behave perfectly, and your income stays flawless isn't a strategy, it's a prayer. And prayers are lovely, but they're not a risk management framework. Number 4, don't chase cheap for its own sake. A cheap property in a weak location with poor fundamentals isn't a bargain, it's a distraction. Sometimes a trap. Sometimes a very expensive lesson wearing a discount sticker. So don't buy because something looks reduced. Buy because the asset is fundamentally strong and temporarily mispriced. That's very different. Number 5, don't confuse action with progress. Some people, when uncertainty rises, feel this overwhelming urge to do something, anything. Refinance everything, sell something, buy something, change everything. Call 3 mates and become a war expert by Tuesday. But motion is not always progress. Sometimes the best action is preparation. Sometimes it's restraint. Sometimes it's waiting with purpose. And sometimes it's simply strengthening your ability to act later. Number 6, don't outsource your thinking to the crowd. The crowd is excellent at one thing, being late. Late into fear, late into euphoria, late into uncertainty, late into regret. Now, the herd has many talents, but timing's not one of them. If you wait for the crowd to feel safe, the best value is often long gone. So the herd usually pays a premium for reassurance. That's one of the oldest and most expensive habits in investment markets. So yes, listen widely, but think independently. And lastly, number 7, don't forget who you are. This one really matters. Your strategy must match your age, your income, your goals, your stage of life, your risk profile, and your personal capacity. Not mine, not your neighbours, not the loud bloke online who thinks he's an economic genius because he owns a podcast microphone and a ring light. So don't make identity-level decisions based on someone else's circumstances. Make decisions that suit your map, your buffers, and your future. So if I compress all of this into one simple playbook, it's this: stay calm, strengthen buffers, control costs, curate your inputs, know your buy box, buy quality if opportunity emerges, avoid panic, avoid junk, think long term, and act from strategy, not fear. That's the playbook. Not sexy, not dramatic, but effective, like good plumbing. And that's what good strategy usually looks like. So, freedom fighters, let's boil this all down. Because if this episode has done its job properly, you should now be less scared, more informed, and much clearer about the difference between a dangerous world event and a dumb financial reaction to a dangerous world event. So let's finish it the Get Invested way, starting with the Fab 4 bushfire lightning round. Question 1, what's the single biggest risk to Australian property if this Middle East conflict worsens? It's not missiles landing in Melbourne, it's the indirect squeeze of higher energy costs, weaker confidence, delayed rate relief, and tighter household cash flow. That's the real pipe work. That's how trouble travels from a geopolitical hotspot to your local housing conditions. Question 2, will this crash Australian property? Not automatically. That's lazy headline logic. What it's more likely to do is create a much more uneven market. Some areas wobble, some stall, some hold firm, some become more negotiable, and quality assets in quality locations still tend to outperform generic stock. So this is less likely to be a universal property crash story and more likely to be a selection story, a finance story, and a behaviour story. Question 3. Who's most exposed? Well, the thinly buffered, the highly leveraged, the highly emotional, and the households most exposed to rising costs, long commutes, tight cash flow, and hope-based planning. In short, people without margin. Because when the world gets more uncertain, margin matters. Question 4. Where's the opportunity? Well, opportunity usually appears where fear is loudest but fundamentals haven't been permanently broken. So for calm, well-prepared, well-advised investors, these periods can create rare chances to actually secure quality property at better prices with less competition before confidence returns and the herd comes clattering back through the gate like cattle late for breakfast. Okay, let's now consider some final food for thought. Here's what I want to leave you sitting in your head like a pebble in your shoe. Certainty is comforting, but it's rarely cheap. By the time everything feels safe again, the best opportunities have often already moved. That doesn't mean you should rush. It doesn't mean you should speculate. And it definitely doesn't mean you should buy rubbish because the news is scary. It means this. In every crisis, there's a small group of people who stay composed, strengthen their position, and quietly act while everyone else is still waiting for an engraved invitation for the future. And over time, that difference in behaviour often matters more than the crisis itself, because conditions and values move, sentiment swings, governments intervene, reserve banks pivot, money gets printed, and fear fades. But quality assets held by prepared people tend to keep doing what quality assets do over the long term. They keep growing in value, and that's the deeper lesson. Now, here's your quote of the week. The herd pays extra for reassurance. What does that mean? It means most people don't pay top dollar for value. They pay top dollar for certainty. They wait until the headlines calm down, the experts start nodding, the mood improves, and the crowd decides it's safe again. And by then, they often end up paying more for the very same asset they were too frightened to buy earlier. That's why calm, clarity, and preparation are such valuable traits. Because in times like this, reassurance gets expensive. So let me pull together the key take-homes and must-do action from today. First, don't get emotionally hijacked by the media fear factory. Stay informed, yes, but don't marinate in 24/7 war porn and call it research. Second, understand the chain reaction. This story is not really about maps and missiles. It's about oil, shipping, confidence, inflation, rates, borrowing power, rents, and household cash flow. Third, remember that not all areas and not all households will be affected equally. The biggest winners and losers will be determined less by the headline and more by their buffers, their debt, their location, their asset quality, and their emotional discipline. Fourth, if you're a buyer or investor, tighten your filter, not your panic. Know your buy box. Prioritize quality. Focus on scarcity, cash flow resilience, and long-term desirability. Fifth, if you already own good assets, don't make permanent decisions based on temporary fear. Strengthen your buffers, protect your cash flow, review your risk, but don't confuse noise with a broken strategy. And sixth, run the calm CALM cycle. Control your thoughts, your costs, and your circle of influence. Activate access to buffers and liquidity. Leverage expertise and genuine opportunity. And manage your mindset, monitor the landscape, and morph early as conditions change. That's how you survive, and that's how, over time, you position yourself to thrive. And if you'd like to stress test your personal approach to any of this, your strategy, finance, property, risk, timing, or what the right move looks like for you given your age, income, debt, assets, and goals, feel free to book in with me for a personal solution session. I only make one of these available every week, and they tend to book out well in advance. So if you'd like to jump in and work through your situation in detail, I suggest you do that sooner rather than later. But no pressure, only if you need it. And if you want to keep learning and keep the conversation going in a like-minded circle of safety, come and join us in the Property Hub Collective Facebook community. It's a great place to connect with other aspiring and existing investors who are trying to do property properly without getting lost in the noise, the nonsense, and the next shiny object. And if you want to build your knowledge more deeply, you can tap into my education programs by clicking the link in the show notes. There's the Freedom Formula program for aspiring investors who want to understand more about the why, the what, and the how of property. And then there's the more advanced step-by-step property wealth program for existing or second-time investors who want to learn how to do property properly from end to end. And the good news is the first module in each of these programs is absolutely free, so you can try before you buy. And please, I'd genuinely love to hear from you. Feel free to email me directly at bushy@khgroup.com.au with your feedback on this episode or any others, along with topics, questions, or guest suggestions you'd like me to tackle in the future. Because podcasting can be quite a lonely echo chamber if you let it be. I'm always looking to improve, keep sharpening, and give you the value and insights that you actually need. So here's the bottom line. When the world gets noisy, don't try to predict every headline. Position yourself to survive uncertainty, adapt early, and act wisely. Because the people who build lasting wealth are rarely the loudest. They're the ones who stay calm, think clearly, buy quality, and keep moving forward while others are frozen between fear and confusion. As I often say, don't let short-term noise knock you off your long-term GPS. So thanks for listening, and remember to always get invested. Thanks for tuning in to Get Invested on the Property Hub podcast channel, your home for property investment insights and inspiration. Make sure you subscribe to Property Hub for free. Get your weekly dose of Get Invested inspiration along with every episode of Realty Talk, Australia's top online property show for red-hot property investing news and insights direct from industry leaders and influencers. And finally, I'll see you next time.